Good morning,
Okay,
guys. We're here with David De Leon, and we are on our renovation loans part 2. Thank you for being here, David.
my pleasure. So, do you like it better this way, or does it not matter?
That way we can see it's fine.
This way is good?
Yeah, that's fine. We're all able to see it.
Okay. Okay, perfect. All right. So what is a renovation loan? This is what we're gonna cover today. 6 basic points. What's a rental loan? What's the process? What are the different programs? What are the benefits of them? How do you get started, and how do you determine the loan amount? Right. So first off, if you go to here to slide 3, what is a renovation loan? Number 1, it's a single closing. We discussed this last time. It's not multiple closing, it's one closing. Everybody gets paid, and all the work happens after closing because that repair money goes into escrow. Familiar Fannie Mae and FHA income asset credit underwriting. That basically means these are, at the end of the day, they're conventional and they're Fannie Mae and FHA loans, period. So all the qualifications, the way you calculate income, minimum score, DTI, all the guidelines remain the same as far as income qualifying. Familiar non-rental conditions and new rental conditions. So basically, when the originator gets their approval, they're going to be able to see all the rental conditions are separated out from the non-rental conditions, and those rental conditions are handled by our rental desk, which is a major burden off of everyone's back because this means nobody has to chase the contractor and nobody has to chase the consultant. That's Remen does.
David, sorry to interrupt you, but the presentation went away.
I know. I think what happens is my screen went black, so I think I just have to remember not to let it fade to black. So okay. So renovation work begins after closing. We discussed that. No rental work can ever happen prior to closing. Lender handles contractor docs from renovation. Believe me, this is the biggest headache off of everyone's back. And if you talk to people who have been in the industry for 10, 15 years, and you mention renovation loans, even up till 2-3 years ago, it was you would see like people run for the hills. Oh my God, a rental loan, not another one of those. I'm never going to do one of those again. Because everybody remembers 10, 12 years ago, a rental loan where the loan closed, they got paid, but for the next 4 months, they were bothered with calls and text messages about the work. So yeah, we've come a long way, rental in general. Slide 4, renovations on the, let me see what's renovation loans. So slide 4, 2 key advantages. I think I skipped one. Yes, here we go. Key advantages. Cash out home equity loan is, loan amount is based on the current value, right? So this doesn't really pertain to us, but on a refi, why would somebody do a renovation refi versus a cash out? That's why, because a cash out is going to be based on the current value. The renovation refi is based on the future value of the property once the work is done. The other alternative, hard money, personal loan, credit card, all much higher interest rates. The benefits of the rental loan, like I said, it's all based on after improved value. Now you're dealing with Fannie Mae and FHA rates, and you have the options that you have under both of those programs with the buy downs, 3-2-1. We do all of them, and you can apply anything that you would on a non-rental loan to the rental loans. Renovations on the rise. This presentation is dated in the middle of last year, so about June 22. So it was already on the rise then. Now it's just exploded in the sense that it's not anything new. It's always been there, but during the pandemic, especially, no seller had time for renovations. Obviously, it was just hard enough to get your offer accepted. Never mind telling the seller that you're going to have the contractor come visit the property too. So now, big shift, renovation reasons is back. Obviously, the inventory is older. Obviously, people have a price point and they're getting outbid, right? So now they're starting to look at, well, what if I go a little bit lower, but I use that extra money in my purchasing power to renovate the property? And I don't have to tell you, people are moving less, right? So that's obvious. For multiple reasons, they're moving less. All right, so renovations on the rise. I have this here, so let's go benefits for all. So the benefits of your home: make the home of your dreams and fixed an imperfect home in a right neighborhood. I told you this story last time. Nothing more powerful than that borrower walking out. I love this neighborhood. I love the schools. I love everything, but I can't buy the house because of X. Not enough bedrooms. Bathrooms are disgusting. Basement is gross. That's going to cost me a lot of money after I buy the house. So no thanks. But if that borrower knew right in there that borrow the money to buy the house, fix whatever issue that they had with it, all in one shot, and this is your payment, without that repair. This is your payment with that repair, and they say, "Wow, that's it. That's what my monthly payment does." If I'm going to take out $25,000 to redo the kitchen. When they see the numbers, that's what really hits home. But obviously, if we don't know to offer that right then and there, the moment is gone, the magic has left, and the opportunity is gone. Real estate agents, move aging listings, obviously, show home potential versus current status, big plus, and obviously move homes faster. Benefits to the contractors, we really don't care much about those, but bigger projects, adding access to funds, increased referrals if jobs are well done. That is true. That is definitely a benefit of the contractor. Now they're on our approved list. Inevitably, they get put in front of people who request our list of approved contractors, and it's definitely a plus for them. Now, one of the negatives to a contractor is the payment terms, but remind me at the end, we're going to get into that because a lot of contractors basing their thinking on renovation loans on the older way they got paid, the black and white guideline way they get paid, which is if the job is over 35,000, no upfront money to the contractor. So you'll see contractors head for the hills when they see this, when the job is that much, because then they say, well, that means I'm not going to get any money to start. But in reality, if I was a contractor, I know that I would trade the fact that, okay, I might not get any upfront money to start, but the bank has all the money. It's in escrow. There's an agreement here. I do my job. They release the money. I don't have to worry about chasing the borrower for the money. I would definitely trade that on any day over chasing a borrower for money. But a lot of the contractors can't start the job. And I'll get into the payment terms later, but it's a big benefit and a big change to them. So this way, if you run into that obstacle or are saying, hey, my contractor says he doesn't do renovation loans because they don't give him any upfront money, you can tell him that Remin will give him 50% of the materials cost upfront. But I'll get into that at the end of the presentation. So let's get into the process. That's slide 7. The process is simple. It starts at, what is that, 1 o'clock up there, purchase or refi, right? Then you go to choose the program. Obviously, if somebody asks me, do I go FHA or do I go Fannie Mae Homestyle? The answer is whatever you would normally go if it wasn't Reno. So there are subtle differences, but mostly it's going to be, hey, what would be my program if I didn't have a renovation loan? And whatever that is, that's probably the way you're going to go right now. Find a contractor, hire a HUD consultant. So you'll see their HUD consultant, anything over 35,000, 203K, and it's 15,000 on a home style or anything structural. 15,000 is probably a little on a home style. It's not so much dollar amount that triggers the need for a consultant. It's really complexity of the job up until you get into the higher costing jobs. What is a consultant? A HUD consultant is, he represents the borrower. He's approved by HUD. And in reality, most of them are either or previous home inspectors. So the HUD consultant, yes, sometimes they're required on Reno, but it would be completely redundant to get a home inspection on top of your HUD consultant. So in reality, that really takes the place of the home inspection. And when you think of it that way, and if you remember that the borrower can borrow the HUD consultant fee in their loan amount if they choose, then really it just becomes a win-win because the consultant is going to be the main point of contact after closing to handle all draws, any changes, right? And I stress the word changes because changes happen. Borrowers request them after closing. They're a nightmare without a consultant. But with a consultant, he handles everything. He's the point of contact. He's worth any, especially remember that you can borrow his fee in the loan amount and be reimbursed for it. Determine the loan amount. That's what we do with the loan originator on the Max Mortgage worksheet is possible loan amount. Then you submit the file, you order the appraisal, and in here you clear the conditions, you get the closing. And then post-closing is once that loan closes, everybody gets paid, all commissions are paid out, seller gets paid. That repair amount goes into escrow, managed by Bremen based on the draw schedule. And that goes on until the draws are over, final inspection, and then the work gets closed out. So next slide, slide 8, roles, contractor. What do you need to know about the contractor? Needs to be licensed, needs to be insured, and doesn't require, it says experience there. The bottom line is if the contractor's been in business for less than a year and he can't really provide 3 references, then they just have the borrower basically just go on there and write a letter and confirm that they understand that they're doing business with a contractor who's been in business for less than a year. So I don't want them to think that they can't use a contractor unless they have a lot of experience. As long as you're willing to attest to the fact that they understand that the contractor has limited experience, but they're choosing to go with him anyway, then that's fine. HUD consultant, we just touched on it briefly, independent third party, works with the borrower and the contractor. What is his job? He provides a feasibility analysis for the project. He's basically going in there and saying, once this work is done, the property will meet minimum standards for either FHA or Fannie, and that the price, the cost of the work is feasible to do it for this amount at this time. Lender draw department, that's us, works with the contractor consultant to facilitate post-closing draws, which is obviously the draws after closing. Each program handles draws differently. I'm just going to stop here. Does anybody have any questions? Because I can't see you. Because I'm looking at my share screen and I don't think you can see me because my camera gets turned off when that's on. So I just want to make sure nobody has any questions before we go forward.
I'm actually sharing my screen because yours stopped sharing. Can everybody see it?
Oh, really?
Yeah, it's okay. I was sharing the slides, so I'm pretty sure.
Okay, so I'm going to get off mine. Hold on. Let me go back to you guys. Can they see it?
Yes, I can see it.
Okay, beautiful. Okay. So yeah, so I'll keep sharing and you keep going. Any questions? Let's leave the questions for the end so that way we don't get lost with time track.
Okay, good enough. So now we're going to slide 9. Rental math simplified. We touched on this briefly last time. When you're trying to figure out if a borrower is going to qualify, it's really very simple. You're qualifying, the easiest way to think about it is you're qualifying the borrower for the total acquisition cost, right? So basically, so the purchase price in this example is $100,000 and the repairs are $50,000. So you're really qualifying them on a purchase of $150,000. And if you think of it that way, that's the easiest way to think of it, because in the eyes of the bank, even though the sales contract says $100,000 and even though the seller's price is $100,000, in the eyes of the bank, you're really buying the property for $150,000, which means that the property has to appraise for $150,000. And if it doesn't, then it's no different than a purchase price of $150,000 coming in at $140,000. The bank is only going to land on the $140,000, and the borrower can proceed, but the bank's still going to only land on the $140,000. So in this case, their down payment is based off the total acquisition also. So if you're going FHA and your down payment is 3.5%, it's not 3.5% on just the $100,000. It's 3.5% on the $150,000. And as long as you think of it like that, then it's very easy, because that $50,000 is the repair escrow. So that includes all the repairs, the draw fees, the 10% contingency reserve that goes back after closing. All of that makes up the 50. So if you can take that number and qualify that, add it to the purchase price and qualify them on the total acquisition, that's exactly how it would work. After improved value. Okay, this is pertaining to a refi. So I'm going to skip this into us, but basically, instead of qualifying on a purchase, on a refi, it's just after improved value. So if your house was $200,000 and the work you're going to do, it's going to appraise for $500,000, then the LTV, the pricing, everything is based off of that higher $400,000 value, not the original. So on the refi is really sky's the limit. It's a blank canvas. Whatever you want to do to your house, whatever that value comes in at, that's what your LTV is going to be based on. Total renovations cost. Okay, so let's just look at a sample cost, right? So this is a pretty, and you'll see here on this line item at the end, it includes 6 months of mortgage payments, which is optional. But if you look at this example, big job, right? Contractors bid 200,000. The 10% contingency now looks pretty hefty. It's 20,000. What is this 10% contingency again? It is a requirement of the program that's basically a buffer, right? So they make the borrower borrow that 20,000 and put it into the escrow. That money, that contingency reserve cannot be used unless the borrower acknowledges that it's being used. He basically has to give permission to release that money. The money is there if needed, so the contractor can request it. Why would they request it? For anything unforeseen, right? You open up a wall, oh, there's mold here. I didn't know there was mold here. Oh, there's rotting wood here. I didn't realize that when I did my survey of the job. So now you can't ask the borrower. I mean, we could, but that's what the program's trying to avoid. Now the loan is closed already, and the borrower has to go in their pocket and pull this extra 20 grand out for something that it could have easily borrowed the 20 grand at closing if they knew it was needed, but they didn't, right? So they have this here. Again, it can only be used if the borrower gives permission. And what happens if it's not used is at the end of the job, work order is closed out, that 20,000 contingency reserve goes back to a principal reduction, right? So the borrower will see it on their mortgage statement reducing their principal. $1,000 of permits, architect plans, again, optional, right? What I shouldn't say optional. If needed, if applicable, you would need architect plans, right? So if the consultant says we need an architect plans for this, then yeah, that would be a fee that the borrower. Now you might be asking yourself, okay, 5,000 in there, but the architect's not going to wait until the loan closes. The architect wants to get paid now, like an appraiser wants to get paid now. He doesn't care if your loan closes or not. He doesn't want to wait until then to get paid. So if the borrower shows proof that they paid the architect, that as an option can be included in the loan amount, right? So architect plans, HUD consulting fees, a survey if they need it, right? Those are things that have to be paid for prior to, but they can be included in the repair escrow as an option. Just like the mortgage payments, totally an option, right? So now that brings the repair cost, the total renovation cost to 235. That is the repair number that you would be adding to the purchase price and qualifying the borrower for the acquisition, not just the 200,000. So in this example, you could see big because the 10% is so different, and we have mortgage payment fees and an architect fee. But typically, right? Typically on a regular, more typical job, $30,000, $40,000, you're talking about a $4,000 contingency. You won't need architect plans. Mortgage payments are optional. So the difference between that 40 might be 46,000 in total rent. So next slide, renovation options. This is simple. You got a 203K limited, 203K standard, and the home style. We'll get into the differences in the next slides, but 203K limited is basically a smaller 203K for smaller jobs, $35,000 or less. And the 203 standard is the bigger K, anything over 35,000 and anything structural. So if anything structural, regardless of the dollar amount, it could be 20,000. If it's structural, you need a full K. And then the Fannie Mae home style, Fannie doesn't have two different versions. It only has one main version, a lot easier to understand. And they do 1 to 4 units, just like 203K does. So the next slide, 13, gets into a little bit specifics of each, right? So 203K does 1 to 4 units, 96.5 on a purchase, 97 3/4 on a refi. You're going to see 203K standard, same, right? No differences in what it can do or can't do. It's just in the repair amount. Home style, very different, right? 1 to 4 unit primaries. LTVs are totally different. Now, I will point this out. The slide says 1 unit up to 90 LTV. In reality, it's 95 LTV on singles. It's not a mistake on the presentation. During COVID, they lowered it to 90 LTV, single family max LTV. And the reason they did that is they basically wanted to review anything that was over 95. We typically give exceptions to go to 95. So I don't want you to walk out thinking, oh, if they do a Fannie Mae home style, they have to put 10% down in a single family. No, So if they want to put 5% down, we would need to review it prior to submission. But I would say, I don't want to overpromise here, but I would say the vast majority of the borrowers that want to go 95, as long as your DU approved at 95, it's fine. 1 unit second homes will go to 90 LTV, big difference, right? Because 203Ks won't do them. And then 1 unit investments, 85 LTV on a single family investment, great deal. You usually that is won't do investments. Now the home style only does single families. If it ever allowed multifamily reno, I could only imagine the response we would get. But right now, single families only. Renovation options. Okay, so here's some of the pros and cons, right? And you're going to see a lot of these pros and cons of these are obvious, right? It has nothing to do with renovation. So obviously, both FHA loans, we could look at them together. MI for life of the loan, right? Obviously. Follow standard FHA credit guides. Same for both. Credit scores, this says going down to 620. This has been changed. It's now 580. Different world back then. So 580 is the minimum score for government reno. And we allow manual underwrites. So I don't know how familiar you are with manuals. Sometimes a government loan won't go through DU, but it's still a doable loan as a manual. We allow them, and we allow them on reno. Home style, very similar to a regular Fannie Mae benefit, right? No MI at 80 LTV, right? Great deal, especially those that are in New York, right? Because in New York, there's that MI rule that it's going to take that higher number. So a lot of times on refis, in other words, they're going to take the appraised value and calculate the LTV for the program. So a lot of times you can drop on those refis, even though your rate's going up, if you can get the property to 80 LTV, you drop MI. So a lot of times these people's rates are going up because they're borrowing to do the repairs, but their payment doesn't even go up at all or minimal because now they're totally dropping the MI that they had to carry previously because now their LTV is 80. Next slide.
We have like 12 minutes for questions. I know David has said a lot of information, guys. I feel like the rest if just like the eligible renovations and then that's it. But do you guys have any questions so far? I do have one in this home style. If it's less than 15,000.
If you skip to slide 16, you're going to see them there.
Can you say that again?
So on FHA, oh, me?
Yes, go ahead.
Okay, on the consultants, so if it's an FHA, the line is black and white. It's 35,000, literally black and white. If you're a penny over 35,000, HUD requires a consultant. So FHA, 203K, easy. 35,000, you need one, or if anything is structural, you need one. On Fannie Mae home style, the guidelines will say 15,000. So if you want to use 15,000 as a base, that's fine. Sometimes I have a habit of giving out too much information, and the too much information I sometimes give out is, in reality, the 15,000 is not black and white for Fannie Mae. I think Fannie Mae's number is probably closer to 50,000 when you need a consultant. But it's a gray area with us once you go over 15, and it has to do with complexity of the job. So if it's a $40,000 job and they're putting in a pool, we don't need a consultant to watch the pool guy put in his pool, right? But if it's a $40,000 job and there's multiple things going on, like there's mold in the basement, we're doing the kitchens, we're doing the deck, then yeah, that's going to be considered a complex 40,000. You're going to want one. But if you want to be safe, the answer would be 15. And then if you have any questions over anything, you can send it to Tanya. She can send it to me. We can review it and then give a determination if consultant is needed or not.
And you said
you'll
this
see
consultant stays with you for how long the project takes, right?
Say that one more time.
The consultant stays how can I say this, live in the transaction after closing.
Oh, yes. Right. So the consultant works with the borrower. He's actually in there prior to closing, right? Because he's doing his report. He's walking the grounds with the contracts, coming up with the schedule. And then, yes, it's closed out till the final draw goes out. Yes.
Okay, beautiful. So we have
So Ivania, I
10
wanted,
minutes left.
to make a quick point, which is, so David is the wholesale lender. So basically the benefit to the borrower is that we as brokers, so AceLand will have a bunch of borrowers that the borrower can use. So every bank has different guidelines. So David shared his basically inside specifics for the bank, but I wanted you to know that the programs exist, but if the bank doesn't qualify the borrower, we can use other lenders to qualify him. He's one of my favorite because I personally use them. I like their system. I think that they're easy, but the broker will do a lot of the process for the borrowers. You don't need to worry about too many of the specifics, including like the HUD consultant who will help you connect with the with all that.
Okay, and I have another.
Then how much longer do you have?
We have 8 minutes and 39 seconds. Is there a
All
difference
right, so
in the rate between the limited and the standard?
very little. It's really FHA, so that was one other thing that I wanted to say. The qualification for these loans really have to do with very simple differences. So it's going to be a credit qualified for conventional and FHA, and then the construction and the construction. The rate is very, very small, the difference between the limited and the standard, but you will find a big difference between the home style for conventional and the FHA. Typically, FHA is much.
Okay, and when you say very
the-
little, well, like half a point, a point?
No, usually it's under half a point. You'll
Okay.
find a half a point difference when you go from FH to conventional.
Okay,
I did want to point out a couple things because David was speaking high level because he's from the bank. So I just wanted to point out a couple little things, which was when he was mentioning moving the property from, when you're going after the listing agent or the listing properties, a lot of sellers are already thinking of renovating. So I think this is one program that you can basically let them know that, hey, you don't have to use your own money. So the bank can actually help you do renovations. If they're already in the process, it's simple because we just need the contractor's information. So long as the contractor is licensed and insured, typically we can do this for them. It allows the seller to also sell the property and sometimes gain from the fact that they're using non-taxable income, which they're going to realize as capital gains if they use their own money. The other thing I wanted to say is it maximizes the potential of their sale. I have someone right now that's actually doing one because they have a one-level home in a very desirable town. So what they're doing is they're adding bedrooms to the house. They live in it, so they can do it as owner occupied. They're going to be adding bedrooms, bathroom. It's going for them to sell the house in 2-3 years because that's their plan. They're building it now. They're going to live in it, have their kids grow out of the home, and then in 3 years they're going to sell this home for basically almost double what they're doing now. As David mentioned about the contractors, we do the verification, or the bank does the verification of the contractors. So we'll make sure that they have liquidity. They're not going to be. We do the best we can. Contractors are reliable contractors that don't need this money to basically go off and pay another project. It's usually that they'll take money from one to finish the other. So we're working to not give them too much upfront to secure the borrower when it relates to bigger projects. So when we were talking about those renovations that are not the limited, the big ones, that really helps out the borrower because we make sure that we only give them enough to pay for permits, hard costs, and a little bit to do material, but we don't give them labor. And then like David said, I wanted to point out newer contractors are okay, as long as they're licensed, bonded. And then he mentioned draws a lot. So I wanted to explain what draws were. It basically, it's just scheduled payments. That's all it is. And then, like I mentioned last time, the word escrow is thrown out a lot, which is really, it's just a reserve account. And then lastly, he's wholesale, so most borrowers can't really go directly to a Remin. So AceLand or a broker like myself are the ones that help facilitate the process, because they are the ones that are going to say yes, no, but we're really going to help the borrower package everything so that we can get that yes. And I'm very experienced with this one. I actually worked inside the bank once upon a time. So that's the benefit that you guys can get, is that I really love this program. I mentioned last time I used it for myself. It helped me get into a very desirable town that I probably wouldn't have been able to afford if I wouldn't have bought a home that was a disaster and I fixed it. So that's something to sell to the borrowers too, is when they see those homes that need work, this can help them.
Beautiful. And then we talked about the 6 months mortgage that goes into escrow. Is that something that can be added to the loan, or that's cash to close that the buyer has to bring to the table?
No, those 6 months can be financed. So just to explain on that, so like we said, in the smaller projects, the limited loans, typically those have to be done. What's the rule, David? It's 60 days, right? 60, 90 days, the limited? Oh, we can't hear you.
You're muted.
How about now? Sorry. Yeah, we will on
Yes.
those 203Ks, whether it's limited or full, we still allow 6 months. So you're still good for 6.
Oh, really? That's great. Okay, not all lenders do, so that's a good thing about that.
Beautiful, beautiful. All right, guys, this was a lot of information. We have less than 3 minutes left. Do any of you ladies have any questions? And thank you so much, Tanya, for jumping in and explaining a little bit more to, how can I say, not so mortgagee, but more like for people, so that we can explain to our clients, because most of them don't understand the real estate terms, right?
Right.
Right.
I have a quick question. So I have someone, a seller who's looking to sell soon. Well, I would say like in the next year or so. But first they want to do the renovations. So they have questions about how they can move forward with renovation loans. So I'm not sure exactly how that process will go for them, because it's not listed yet. They want to do the renovations first. They want to add a bathroom, things like that. So yeah. So I wasn't exactly sure the best way to go about, going over that with them.
So in that case, like we said, we can use the renovation loan for them to help them, right? But on a very specific level, that person as a borrower is going to have to decide whether this is beneficial for them, because a lot of times people have different interest rates, because if they've refinanced in the past, there's different options. So they can maybe access money through an equity line of credit if their rate is too low. If not, we can certainly help them refinance. That's what David was going to say. But, as it relates to purchases, he didn't go over that, but we can do the refinance as a 203K. So this is not just for your people that are buying. Your sellers can do, like I mentioned, major renovations or small renovations. The only thing the limit it doesn't cover is structural. But then if it's not structural, and they go above 35,000, we can do the bigger renovation.
Maybe
The benefit they have
can,
with loans are less.
maybe next week we can do that, or
Oh yeah, we can do that
the
offline
seller.
too. If you
But guys, thank you so much. This was
I have
great.
one real quick.
I really appreciate